Hello guys, Leggy here and welcome to a new video. Today we're going to be doing another video on Trading 212. Thank you for support on the last videos. But what's happened, basically, they have just released the Cash ISA. So I believe that this is being rolled out stage by stage, so it's a staged rollout. But how I got it is basically I went onto the App Store and force updated it, so you might have to go and do that. But if we look at the app, it is indeed there. So how to get it, you basically go into the app, and then when you go in the top corner to choose whether you're in the invest account, the CFD account, the cash ISA or stocks and shares ISA, there's two ISA options at the end, which is absolutely amazing. Now, what is actually cool about this is that Trading 212 have actually made this a flexible ISA. So what is a flexible ISA? Basically, if I'm an investor and I put in £1,000 within my ISA, what a flexible ISA allows me to do is withdraw that £1,000 later down the tax year, and I get that £1,000 back into my allowance. So beforehand, basically, if I wanted to invest £200, take it out, but then I decide to put £200 back in, that would be £400 of my allowance gone. Whereas with a flexible ISA, it basically means that if I take that £200 out, I'll get that allowance back, which basically means that if I put the money back in, it will only count for if I put that money in twice in a tax year, that will only account for £200 instead of doubling up and being £400. So basically, Trading 212 also has a variable rate within their cash ISA. So this means that you could be watching this video further down the line. It could be a different rate to what it is now. Basically, it's 5.2%. Now, obviously, rates are really high at the moment, and this is what reflects what the percentage you get back is really. So if they cut rates, they probably cut this percentage you get back as well annually. So you guys might be aware that at the moment, if you have a stocks and shares account and you hold money within your stocks and shares account, they actually offer 5.2% on that. What is the key difference? Basically, in a cash ISA, your money is actually invested in cash, whereas in a stocks and shares ISA, to get that 5.2%, Trading 212 actually invest in something called QMMFs. So as stated by the Trading 212 website, QMMFs are required by regulations to maintain a low risk strategy by investing in financial instruments such as government bonds, so gilt. They subject to higher regulatory scrutiny and must meet higher quality standards. So just know that this is a very low risk thing, but it's still got risk to it, unlike the cash. So it actually says credit risk. If a QMMF in which your cash is invested becomes insolvent, you may lose some of your cash. To manage this risk, we only select high quality QMFs and we monitor them frequently. Like I was saying, it's got an interest rate risk, so the value of assets in a QMF can be affected by the changes in interest rates of central banks. If interest rates rise, the value of existing underlying assets such as bonds might decrease. If we look at the official bank rate from Bank of England, as you can see from 2021, there's been a steep rise in the bank rate and it's currently sitting at 5.25%. So how does the change? So this is from Bank of England website. How does the changes of bank rate affect the economy? The change in bank rate affects how much people spend, and how much people spend overall influences how much things cost. So we change a bank rate, we can influence prices and inflation. Basically, the Bank of England are trying to they've got a target to keep inflation around 2%. It's currently at 2.3%. So when would you use a cash ISA and when would you use a stocks and shares ISA? So basically, cash ISA is the safer option of the two, as you know that the value of your money won't go down, whereas in a stocks and shares ISA, it can go down. This means that a cash ISA has a much lower risk. This lower risk means that they're more suitable for the shorter term, as basically what can happen with the stocks and shares ISA, you can invest in something, you might need the money in 6 months' time, but the stock or anything you've invested in might have dropped, so you might need to wait a bit. for it to be a more suitable time to cash in on your investment. So why would you not go for a cash ISA? Basically, you need to account for rising inflation. Basically, the S&P 500 accounts to beat inflation, has done in the most recent years, whereas I believe the rate which cash ISAs give, you'd be losing money if you accounted for inflation. And then, as I said, stocks and shares. One, you need to actually keep track of your investments. So it could be, it could be a lot more effort to do that. And also, as I said, it's got a higher risk. But I will put a graph up here which basically shows the difference over a 30 period time, which basically shows that if you invest versus savings, you can get a lot more bang for your buck. So I thought I'd turn this into a series, as you got to do as a YouTuber. So basically what I've decided to do, so you guys probably know that I invest £5 per day in the S&P 500. Past performance has actually given 10% annually. In the last few years, it's actually been close to 15%. But we've decided to start that to £5 a day. And I'm going to be comparing it because, I need to build some cash savings anyway. And it never hurts having cash ISA on the go. I'm going to basically track this over time, especially while rates are up. I think it would be interesting over a year. So I'm going to basically invest in the cash ISA, £5 a day, and the SP 500, £5 a day. And, I would expect the S&P 500 to absolutely obliterate the cash ISA by a country mile, but it will be good to see how we can track the ups and downs. But with that, guys, hope you guys did enjoy. Please leave a like and subscribe, and peace.